All right. So everyone, welcome to Forex 101. So this is for people who are completely new to Forex, that may be coming over from either a different financial market, such as options, or new to trading altogether, and they're just beginning with Forex as their way of an introduction to the financial markets. So this is my first time I'm teaching introduction to Forex, and it's literally a compilation of everything I had to piece together over my 5-year trading career, because I was not taught everything that I know in a organized way. So I'm going to try my best for you guys today to shorten that learning curve and get you what I should have been presented when I first became a Forex trader. So hopefully that will give you a better understanding into what we teach inside of the Discord membership. So without further ado, I'm going to go ahead and jump in and get started. Hopefully you guys got the document and the link to the OneNote. I like to use OneNote a lot. So I will be continuously updating the OneNote link with anytime we have like a specialized webinar outside of our weekly classes. So whether that be like this one today, or when I do a class on Fibonacci, and I'll also plan to do a class on I just went blank, but there was in the class, TradingView, because TradingView within itself is very intricate. We do have the basic tools that we utilize, but there's so much more you can do with TradingView when it comes to charting. So I do want to hold a class for that as well, for people who need to become well-versed in how to utilize the platform for charting. So what is Forex? So if you don't know what Forex is, to put it in layman's terms, it is just the foreign exchange market. So of course in Forex, we have what we trade called currency pairs. So what is a currency pair? So a currency pair is basically it's the quote of the exchange rate for two different currencies traded in two different countries. So of course, if you have seen, we have the euro dollar, the US dollar, the Aussie dollar, stuff like that. So how do we make money from this? So the best way that I learned it was, let me make sure I have the chat open so I'm not missing anything. Okay. So the best way I learned it was basically pretend you're traveling, right? So you're traveling out the country. Say you're from America. So we use the US dollar in America. And you're going to let's see, another country. Let me take some people in here. Okay. So the next country I would say is the UK. Somewhere you would need to use the euro dollar. So more people are coming in. I'm sorry, y'all. So of course, when you go to another country, all right, you need to, can someone mute their background, please? So when you go to another country, of course, you'll need to exchange what you currently use from your home country. No, you're fine. To what you need to use in the current country you're traveling to, right? So of course, the exchange rate will matter in that process. So say when you get there, the value of the dollar in the country you're traveling to is lower than what you use in your home country, right? So it takes a lot less of your dollars to purchase that other country's currency. So then you're there, you're traveling, and then you leave and you need to, get your US dollars back. So let's say, for instance, the value of that dollar in that country you're visiting is even cheaper when you're leaving the country. So of course, when you exchange your money back for US dollars, you get more money. So you're coming back out, you're leaving out the country with more money than you came in with. So that is basically what we're doing when we trade currency pairs. You're basically profiting off the fluctuation of the exchange rate between one country's currency versus another. So that is what Forex is typically. And money is always being, utilized. Money is always like flowing no matter what country. So that is why it is such a liquid market to trade. So that is it. Does anybody have any questions about what it is, what Forex is, and how we profit out of the Forex market? I hope that analogy made sense. Let me see and bring up my other screen here. Okay, there we go. Okay, cool. All right, so let me break down the currency pair here. So I'm gonna type, see here. So when it comes to a currency pair, we have the euro versus the US dollar. Okay. So the first currency in this pair is going to be what they consider the base currency. And then the second one is considered your quote. Is this on TradingView? I'm just using TradingView as a whiteboard. So yeah, but this is just me presenting, but I'm just using TradingView as a whiteboard to do it because we'll get into charts and stuff later. So we have the base pair, which is the euro in this currency pair, and then we have the quoting pair, which is the US dollar. So what this means is basically the quote pair is how much of the US dollar is it going to take to purchase the euro dollar. So this is what this format means. So of course we don't really have to delve deep into that, but that is why one is in front of the other when you're trading it. So of course we have majors where this is a major pair. Major pairs are usually paired with US dollar. So that's whether the US dollar is in the front or the back. So you have USD, JPY, Euro USD. Those are most of your major pairs. Then you have minor or cross pairs. So that would be Euro, JPY is an example of a minor or cross pair. And then you have what's called exotic pairs, which are pairs that I don't typically trade, but they're typically a pair, the currency that comes from a majorly developed country versus a currency that comes from like a low volume traded currency. So that would be like USD versus, I think it's the peso in Mexico. So that would be exotic. So those are the three major classifications of the currencies that you'll trade. You'll mostly see me trade major and minors. I don't trade exotics. But if you want to, you can. You just use the same thing that we teach to trade the other two, just the same. Any questions so far on that? All right. No questions? Okay. And please, if y'all want to come off mic, please do. This is for you guys. So if, like I said, this is my first time teaching intro. So if there's something that doesn't make sense or you need more clarification, and if I have an answer, I will get it to you, give it to you. If I don't, I will let you know that I'll research it and get it back to you. Okay. So that is currency pairs. So of course, currency pairs has prices, right? So if we look, let me click on a different one. Okay, well, it's not really showing prices right now on this, but to our right of this chart, this would be a whole bunch of price quotes. So of course, you know, on a chart, price fluctuates up and down. So that's what you see to the right. So why is that important? Well, we want to be able to measure that movement, because if we measure that movement, we can calculate how much money we can make if we take the right direction of that currency pair. So we measure currency pairs in pips. Okay, so we have pips is what we use to measure the fluctuation between one price quote down or up to another. So how do you calculate pips, and how do you know how much a pip is worth? So typically, when you look at the price of a currency pair or quote of a currency pair, let's say, well, for example, a random number 02534. Okay, so typically that number, you're going to start measuring pips from the fourth number in this whole like numerical lineup here. So the fourth digit is what matters. You're going to drop the fifth digit if you have a fifth digit. If you have four digits, you're going to drop the fourth digit. So in this example, I'm going to give you two different numbers here. Okay, so let's say this is some currency pair and it went from this price quote and it dropped down to this price quote. So we need to figure out how many pips that is. So what you would do is you're going to subtract this number from that number, but before you subtract, you're going to get rid of this fourth or fifth digit. I'm sorry, this fifth digit on the end. Whatever digit is on the end, you're going to get rid of it. It's not going to matter. And then you're going to subtract that, and that will give you how many pips that is. So let me calculate that here. Okay, so that's 1.0253. You don't even need the number before the decimal. You can just do the numbers after the decimal. So let's see, 0.0253 minus the 233. So that's a 20 pip drop. Okay, so that's 20 pips. If you want to be exact, you can subtract the last digit on the end. So subtract this last digit on the end from this one up here, and you could put a point, whatever after that. Most people just want to know the whole number of pips that they're getting. So did I lose anybody in that mathematical equation, or do y'all understand how I got 20 pips from this? Okay, good. Everybody good? Now,
So when on MT5, so when like you go to like your quotes page, we just look at the last two digits, correct? Like the numbers that are like kind of bigger.
let me go to my quotes page here. I'll make sure. So on their quotes page, I don't know if you're looking at it, but on mine's there's like a number, and then there's like a little tiny number to the top right.
Yeah.
So
Mm-hmm.
that little tiny number to the top right of the bigger one, that is what I'm scratching off, because they
Okay.
make it little because that doesn't really matter to most people. So
Mm-hmm.
they already kind of drop it off for you when they do that.
Okay, sounds good. Thank you.
You're welcome. Alrighty, so but me, I haven't done this manually in years, because honestly, you have a plethora of tools you're going to use when you chart to calculate pips. One major tool I like to use is the ruler here to the left on this vertical line of icons, and you can just click one place on the chart wherever you are, where price is, and then move it up or down, and it's going to give you the number of pips here for you. So you don't have to do this manually. You can just utilize the tools at your disposal to just quickly calculate that stuff for you. So that will make things a lot faster for you. But just in case you wanted to know how that comes about, that is how pips are calculated. Alrighty. So now the next thing is, well, how much is a pip is worth? So one pip is going to be worth whatever you risk when you enter a trade. So the main formula I go by is, and of course in Forex, we use lots. So I don't know if y'all have heard that thrown around a few times, but when you start placing trades, you're going to enter your trades based on lot sizes. So the main lot sizes that are used are 0.10, 1.0, and I forgot the lowest one, 0.01. So let me do this. Okay, so those are your main lot sizes, 0.01, 0.10, and one standard lot. To calculate whatever I need to know, the main formula I'm going to use is one standard lot, which is 1.0, is equivalent to $10. So why do I use this formula? Let's see, one standard lot. Okay. So I use this formula is because whatever lot size I'm using, whether that's a 0.5, a 0.25, a 0.75, something unregular, like whatever it is, all you got to do is multiply by 10, and that will give you your value of the pip, the dollar per pip. So if I'm using, let's say something random, 0.64, that's my random lot size. All I got to do is multiply that by 10, and that is going to believe that's $6.40 per pip. Let's see. Yep, $6.40. So multiply that by $10, and that is $6.40 per pip. So that is how I'll figure out every time. If I need to do it in my head, that's how I do it in my head, to get how much. Now, this is only going to be for, I want to preface this by saying this is only going to be for major pairs. So anything that you trade with a US dollar attached. So your Euro USD, USD JPY, AUD USD, this is going to be accurate. If you trade anything like an exotic, a minor, any of those, you're going to have to use a calculator for that. You're going to have to use a position size calculator, which I have listed in resources. And I went over in our risk management video. So if you just go to, and I showed it before, if you go to myfxbook.com, go to the FX calculators, and you choose position size tool, this is where you would put in any other pair besides a major, and it will calculate it for you. So let's say, for instance, we're doing GBP CAD, and then you put your currency that you're trading in, your account size, how much you're risking, which for me, I always preach 1%. And then whatever your stop loss is. So before you ever come to this calculator, make sure you know how much your stop loss is going to be in pips. So let's say, for instance, our stop loss is 20 pips, excuse me. Hit calculate. This will always be 1 if you use this calculator. This trade size is always 1. And then it'll tell you down here, you need to use a 0.68 lot. So how do we know how much? Well, can anyone tell me how much the price per pip is going to be based off our lot size? Based off of the 1 standard lot equaling $10, how much is our lot size going to be? How much is our pip value is going to be based off of our lot size?
$6.80.
Correct. Yes. Okay, good. So again, this is listed in resources. And if you want to go deep into risk management, just to save time, I don't want y'all here all Saturday, but I do have a video on risk management and how to calculate your lot sizes. It is also, I linked it into the document that I uploaded. You can just go there or go to the channel in the Discord and watch that video. It will show you everything you need to know about risk management and how to get your lot size. Okay, so any questions on that so far? Okay, good. No questions. All right. So let me see what's next here. All right, so on your chart, or if you're on MT4 or 5, you'll see something like this. Let's see. It's not going to show it on here either. Well, I'll just illustrate it here. Okay, and then you'll have something that says like bid. And ask. Simone, I'm sorry, I missed your question. You said, so if the number is like 1.986, yes, you're going to drop the 6 on that. I hope that's what you were asking. I hope I answered that correctly. Okay, so bid and ask. So why is this important? So the bid and ask necessarily for me is important because the middle of the bid and ask is what is called your spread. So I'm going to label that spread here. Okay, so why is spread important? So when it comes to choosing a broker that you decide to trade with, a lot of experienced traders will ask brokers, well, what is your spread? Or do you charge commission? So typically, if the broker is not charging commission, they're going to have probably larger spreads. So for spreads, they will eat into your profits. And what do I mean by that? So sometimes spreads fluctuate, like this could get larger and expand, or they can constrict and get smaller. If it's smaller, that means the market is more liquid. If it expands, typically the market is not as liquid, and a lot of buyers and sellers are closing their positions or leaving out the market, or the market is coming to a close. So if you enter a trade, let's say during New York session, and your spread is this tiny. So that's probably like, let's say your spread was like 1 pip. So you're not, as you're making money off of the movement of that currency pair, the profit that you're giving to the broker is not that large, right? But let's say you keep your position open and the market's coming to a close. What happens when market close? Your spread becomes from here to right here. So now you probably have like something over 10 pips in your spread. All of this is going, if you were up $500, it's very easy for that $500 profit to now dwindle down to like say 200 or less, because the spread has widened and has eaten into your profits. So this is why spread is important. If you're with a broker who does not charge commission, they're going to make their money from the spread. This is your way of paying into the trade. Commission is usually they'll charge something small, so they'll charge you to enter the trade. So if you pay attention to your balance in your account, you enter the trade and your account will dwindle like maybe $2, $1 to $2, if it's that large. And then when you exit the trade, if they didn't take it out when you enter, they'll take it out when you exit as well. And that's another way your broker will make commission. But most of the time people worry about spread, because spread is what will alter based on the market session or the time in the day. So you want to pay attention to spread, and we'll get into that later when we discuss market sessions and the time that market close. But that is what that is when you see this on your screen. When you see those two lines, that is the bid and the ask, and the middle is what the spread is. You can also see it on your quotes in the MetaTrader, your quotes screen. Below your currency pair, there is usually a little tiny number to the right below it. That is the spread. If you put a decimal, just move a decimal to the left, and that is your actual spread in pips. So let me see. For instance, we choose one that I see right here. So I have one that says, okay. So this is one I'm looking at, MT5, and then below it, there's a tiny number to the right. Put a little dot because there's something to the left of it that really doesn't matter. And then there's a 71. So it looks like that. This 71, just move an imaginary decimal to the left, and that means your spread is 7.1 pips. So if I enter a trade, well, I can't right now because the market's closed, but let's say the market's open and the spread is still 7.1 pips. If I enter a trade for one lot size, I'm automatically paying into the broker $7.10. Now, if the spread gets this big and I'm still in my trade for one lot size, let's say the 7.1 turns into, let's see, for example, this. So this is now the number beneath the currency pair in the quote screen. So it went from 71 to 210. How much is this in pips? What is my spread in pips? Can anybody answer? Anybody? Remember, this was my old spread in pips. It went from, I moved the decimal to the left and it was 7.1 pips. What is this number in pips? Yes, 21. Good. So I have 21 pips for my spread. Now, based off of our earlier equation, one standard lot is equivalent to $10. If I multiply 21 pips times $10, how much money am I paying into the spread? Anybody? Good, $210. So that is why spread is important. I went from paying them $7.10 to enter my trade. I stayed in my trade. whatever profit I made, if I made, let's say I only made $50 on my trade and I left my trade open and the spreads went this wide, you have to now deduct $210. So now you done lost your $50 profit and now you're in the negative, whatever the remaining negative is. So that is why it's important to watch your spread and to also know to be cautious if you're going to hold your trades like a swing trader or a position trader, um, how much you're putting into that trade, because you will have to endure the spread, the time where the spread gets really huge. Any questions on spread and why that makes a difference? So it's all preference. Some people don't mind a broker that doesn't do commission because they're either going to intraday trade, so they're okay with that. They don't want to have to pay immediately with commission. Some scalpers prefer commission-based traders because commission-based brokers, because they know right off bat when they enter a scalp trade how much you're going to have to pay into the broker or pay into the trade, and they don't have to worry about spread eating into their scalps. So it depends on the type of trader you are and what you prefer. Me, I don't care because I'm intraday and I get out before 5 p.m., which is when the spread gets the hugest. So I'm out before market close. So as long as I do my analysis right and I'm in the right direction, it really doesn't affect me much. But you're going to have to pay to play no matter what broker you choose. It's just a matter of what do you prefer and what trader you're going to end up being. Most times, scalper, if you are going to choose a scalp, most of the time you will do commission based, not brokers who bake on the spread. All righty. Any other questions on that? Yes, we'll get into that later too. I will explain the difference between a scalper, intraday, swing, and position. But yes, a scalper is somebody who gets in and out the market really, really fast. They bank on smaller moves, so they don't need spreads eating into their profits, because again, spreads will fluctuate. All righty. Everybody good on what I've went over so far before I move on? And there's a link in the document to go into bid and ask spread and the reasons why spread gets bigger, smaller, and more detail. But that's the main important thing to us as traders, but it will give you more reasons why spread increases or decreases. All right, so next we're going to get into parts of a chart, what makes up a chart. So let me get this off of the screen here. All right, so now we have, we're going to go over candlesticks. So candlesticks are a way of showing you price movement, and the candlesticks are like the little tiny building blocks that show you the overall market trend. So what makes up a candlestick? So let me try to put this on the screen here. Is it? Okay, I can't find it right now, but I had it. Okay, I can't find it, but that's fine. Let's do this. I'm gonna open up a new chart here. Okay. So candlesticks. Here we go. All right, so what makes up a candlestick? So we have the main components, which is the open, the high, the low, and the close. Okay. So the open is going to be where did the candle start based on where the last candle ended. So this is a bullish candle. So that means it opened here, it rose, and it stopped above where it opened. So we all know that's a bullish candle. So this is where the open is of the subsequent candle here at the bottom. Okay. And then what happened when this candle opened? It started moving up and down. So anything that fluctuated below the open leaves a wick here. Then it decided to keep pushing up and it closed above this open, which left this candlestick here. So it made this a bullish candlestick. And then this became the close. So what does this wick mean? So price came all the way up to this point, but it closed below this point. So it left a wick above the close. So does that making sense to how this candlestick formulated?
When you say open and close, that means a new price is starting, or
It means that that's the price level the candlestick opened at. So price is always moving, but these candlesticks are, so first let me preface by saying each of these candlesticks is a representation of time as well. So we're on the 5 minute. So each of these candlesticks open every 5 minutes. And wherever the opening line is the price level that candlestick opened at the new 5 minute mark. So at this time, this was a candlestick at 9:05. So at 9:05, it opened at this level. So this is the price level it opened at. And then price did its thing within this 5 minute time period. It went up and down, and then it closed above its open, but it also closed below its highest point. So that's why there's a wick up here. Is that making sense, or is it still
yeah, that makes sense. Thank you.
no problem? So of course it's the same as a bearish candle. So bearish candlesticks. So here, before this was a bullish candlestick, so it closed above its open. Then at this price level, this is where the new candlestick opened. It decided to fluctuate. It did its thing, but it closed below its open. So it made it a bearish candlestick. And of course, the wicks are price movement that happened above and below the close and open levels. That's what the wicks are. Okay. So everybody in agreement on how a candlestick is formed and what it represents on the chart? We're good. Yay, nay. Want to make sure we're all good here. Don't want any confusion left behind. Okay, good. Okay, cool. So now we have the building blocks of our chart, which is the candlesticks. So now we go into swing highs and swing lows. So of course, we all know that as price moves on the chart and it makes these candlesticks, it's going to fluctuate in the way that the volume pushes it up or down. So of course, we know that as these candlesticks are forming, we have highs and we have lows. So in this one, let's say, for instance, here, we'll call this a little downtrend here. It created this low and then this high. Okay, created another low and then this high. Now, some people harp on this very much. But I would say just do where your eyes naturally tell you to go. I think people forget that you don't have to really be so hard on yourself when you look at a chart, because charting is still relative. It's based on what do they say? Beauty is in the eye of the beholder. Okay, everybody sees something different on the chart. So it's okay if you don't see the same thing as the next person. Especially when you're beginning to do this, you're fresh and you're new to it, you're trying to tune yourself to it. Just do what your eyes naturally see. So some people may not have seen this high here, and that's okay. Some people will come all the way down and say, well, this is my next high, and that's completely fine. Just keep doing it over and over and over. And the more you do it, the more you'll become more intricate at it. But don't harp so much on, okay, I didn't see that high, I didn't see that low. Do what naturally flows to you. So if your eyes naturally says, okay, well, I see this, that's what your eyes naturally pull you to, that's okay. If your eyes naturally pull you to this, because I did this in the beginning, I used to do this. I forget all about those little minor structures, and this is what I would chart. That's okay. This is still a high. This is still a low. So again, do not harp on trying to get everything completely right. Charting takes time and it takes practice, and it's something that it can't be completely 100% taught. It would take you to get on the chart every day and look at price action. So is that making sense, guys? Y'all following me so far? Okay, good. All right, so the candlesticks come together like little soldiers. We make our highs and we make our lows, which now leads us into market structure. So when somebody says a swing high or swing low, what I just charted here, this is a swing low. Okay, this is a swing high. This is a swing low. This is a swing high. So if we're coming up to make a high, that's a swing high. If we're coming down to make a low, that's a swing low. So if anybody ever tells you that, that is what they mean. Okay, so I just wanted to make sure that y'all understood that terminology there. Does everybody understand higher highs and higher lows, lower lows and lower highs? Is everybody on the same page with that, or do y'all need me to go into that as well?
So is there a difference between higher highs and higher lows and swing highs and swing lows?
Yes.
Or is it the
So
same?
there is. So swing when people usually say swing high or swing low, they're talking about macro structure. And when I say macro structure, when you zoom out and you see the bigger picture. So when we zoom out, we see that this is one big swing low. This is one big swing high. But if you zoom in, you'll get into the minor structure. So we'll see here, like, let me get the higher high. Actually, that's a lower high. It's my bad. So right here is a lower high. Right here is a lower high, actually. That's just a high. Lower high here, lower high. So if I zoom out again, you see that this right here is our swing low. And in a bearish trend, we have lower highs, right? So this is our swing low. And then within that swing low, we have minor structure, and that is all our low. These are all our lower highs and lower lows. Lower lows are behind this. What time frame do I chart on? I'm mostly on 4 hour for my major structure, and then I drop down to 15 and 5 minute. I do look at the daily, but it's like 25 to 30% of the time I'm looking at the daily. I rarely look at the daily anymore. That's not to say it's not beneficial. You can, but for me personally, I've left from charting on the daily. And again, that is something that will be up to you as a trader. I can teach you the technicals. I can teach you how to chart. But I can't teach you what kind of trader you're going to be. You have to decide that on your own with experience, and it will change. I changed over the years. I used to delve into scalping, decided scalping wasn't for me. I became an intraday trader. I used to do top-down analysis and trade down from the daily, decided that wasn't for me anymore, and I just needed the 4 hour. Again, these will be things that will feel more comfortable for you. My mentor doesn't trade like I did. Like, we traded different, but she taught me how to chart and mark up. And based on what I saw after I did my markups, that is what kind of molded me into the type of trader I decided to be, if that makes sense. Okay. So does it answer the question about when I said major, I'm sorry, swing high, swing low versus the lower highs and the higher highs?
Yeah, so when we are like, say we're new to charting,
Mm-hmm.
so when we first chart, we mark our higher highs, higher lows and all that.
Mm-hmm.
And then do we go look for the swing highs and lows, or is there one that we should be looking for first or second, if that
Um,
makes sense?
That is a good question. So based on how we teach in the discourse, so of course we teach you guys to find your major or your macro structure on the 4 hour, right? So in this instance, this is just me working off of one time frame, but we work off 2 time frames when we teach you guys. So I'll go up to the 4 hour. Okay, and then this is where you'll be finding your swing highs and your swing lows because this is the higher time frame we're starting from. I don't like how this is looking over here to the right, so I'm gonna move over. Let's see right here. Okay, so of course we start on the 4 hour. We zoom in a little bit. We're zooming in because we're going to be moving down to a smaller time frame. So this is going to be really huge on a 15 or a 5 minute. So you're going to zoom in a little bit, and this is going to be your swing high and swing low. So this is a swing low, swing high, swing low, swing high, swing low. Okay, so that's because this is our macro structure. Then we go down to our minor structure. So let's say 15 minute. Now you see how huge that major swing low is. This is where we find our microstructure, and this is where we pull out the lower high, lower high, lower high, lower high, lower low, lower low, lower low. Does that make sense?
Yes.
Okay, good. Are you looking at this section because it's a major move? Um, are you saying like this one major section here that I drew from the 4 hour?
Yes.
Okay, so I'm looking at this is because this is like, if this was in this point in time, this is the last swing low, and this is what's letting me know what price is currently doing from this major move on the higher time frame. The main reason we do our swings on the 4 hours because on the lower time frame, it will give you multiple tinier entries to get in on the trend. Because of course a 4 hour trend is much larger on the lower time frame. So I have what 1, 2, 3, 4, 5 times I could have entered for a sell on this major swing low here. So this is the current swing. So I want to find my smaller entry points during this swing. Did I answer your question correctly, or I want to make sure that I'm not misunderstanding you? Essence, is that making sense? Or did I answer that right?
Yeah, I got it.
Okay, cool. All right.
Thank you.
No problem. All right. Any other questions on the major swings versus minor structure and finding your lower lows, higher lows? Okay, good. And I'm not going to go too in deep into that either because we teach these during our classes. This is just to get you the foundation to understand how we got to why we teach break of structure, change of character. Okay. All right. So now we're going to get into marking up a chart. So this subject is extensive because there's so many ways you can mark up a chart. So I'm just going to go over a few examples. I'm not going to go over everything. But the main ways that people will mark up a chart, they'll utilize trend lines. They'll look for chart patterns. Some will use indicators, or some will just do what's called naked trading, which means they just look at strictly price action and don't use anything else. They'll just enter the market off of what they see. And some people use zones and points of interest. So if you've been to our classes, you know we utilize zones. My zones are order blocks and fair value gaps. And then we use pure price action. So a little bit of naked trading, I guess you can call it. So let's see, for example, let's say you were starting to mark up a chart here. Our instructions for you guys is to start on the 4 hour. Okay. And then like I just did, find your highs and your lows, your swing highs and your swing lows on the 4 hour. So of course I'm gonna put that right back, but this time I'm gonna do it like this. If you need to do this to give yourself some sense of what's happening, that's okay too. I do this sometimes if I need to give myself a clear indication of what's going on the chart. That's fine. And it also helps me do that when I start plotting my highs. So we go like this. So these are my highs. Now, why do I put these lines here? Is because once price comes above these, we have a break. So if nothing is coming above these lines, that means structure hasn't broken on the macro structure. So I'm plotting my highs here. And then these are my lows. And you can color code them, whatever you need to do. Again, your charting is your art, so it doesn't have to look exactly like however someone else is doing it. Make sure it makes sense to you. As long as you're, some things need to be correct, like your lows and your highs do need to be correct because we don't want you trading opposite or, the wrong way. So make sure you do, at least if it's a low, make sure it's a low on your chart. So this will be sometimes a way people will mark up. Some people will use a trend line. So if I was going to put a trend line on here, this would be a bearish trend line because we're moving down. What constitutes a trend line? You need 2 points that touch, and it doesn't need to be going through the candlesticks. That is what a trend line is. If you need to put one on there just to give yourself a sense of direction, you can do that as well. What is a zone? Some people, for me, y'all know I like fair value gaps. Here's a fair value gap here. I'm not going to go into fair value gaps deeply, but this is my zone. Okay, this can also be called a point of interest. So some people will mark a zone to mark up their charts. Okay, there's also order block here. That's another zone that I like to plot on my chart. Okay. All right. And then some people will use M's or W's. Let's see. Let me find one here. Here's an M. This is what's called a breakout pattern. And why is it a breakout pattern? Because typically when you have an M or a W, it will break the neckline here. So this is a bearish M. It broke and then it just dropped from there. So that's another way people will mark up their chart. Again, like I said, there's a plethora of ways you can mark your chart up. We don't teach everything because we use what's going to get you effectively into a trade and out of a trade the most on your chart. So we typically just go with the highs and the lows. We tell you how to mark your break of structure. We tell you how to mark up a change of character. Those are very key pieces of price action you want to know on your chart. So we don't teach all the M's and the W's. I mean, if you want to learn M's and W's, you can. I see them all the time. They're very tradable. So if you want to do that, you can. I would say if you want to learn more ways like chart patterns and stuff like that, you can Google them, find different pictures of what they look like on your chart. And if you see, and I always say, if you see them all the time, if that's what your eyes see, mark it. I see M's and W's all the time, so I still mark them. So you don't necessarily have to do it because someone else is doing it. Like mark what you see. And don't feel you're wrong, mark it. And then if you want, someone else to look at your chart and say, hey, I see a flag right here, or I see a wedge right here, or I see a W, like, do you see this? Like have somebody review your chart and see, like, at least let them know what you see and if you're marking the right pattern at the very least. So that's why we say at least try to chart every day and have someone review your chart. That's how you get better as well. But those are different ways to mark your chart up. The main key elements you want when you're marking up a chart, or the questions you're trying to answer, is what is price currently doing? What trend am I seeing? And what is my entry point? Okay, where could price possibly go? And there's no right or wrong answer for that either. Like sometimes if I'm marking up a chart, I would do something like this. Like price could either come up to my area. I'll make that a dotted line. Okay. Or it can just continue to push down because we can't predict price. Price tells us what it wants to do. We just follow price. So you can do that and then just watch price and see what is it going to do. We don't know the answer yet. We have to wait till price starts doing what it wants to do to show us. So that is the whole point of marking up a chart. So again, you need to know what is the current trend? Where's price at? Where do you think it's going to go? And what's your entry point? Okay, does anybody have any questions on that process or anything that I've shown so far? Everybody good? I can't see my okay, I don't see any yeses in the box. So if you're still confused, please let me know. This is the time to do it. Okay, you're finding having okay. So I'm trying to decide if I want to spin this zoom on entry because that is typically what Jigga goes over, and he has a whole video on entry points. Is that video, have you watched that? Are you still confused by it? Like, did you attend the entry? Like, did you attend this class based on like on getting it and it still didn't make sense? Okay. All right. I can kind of briefly go over it now since I already have like a markup here. Let me see. I'm gonna start from right here. Let me see if I can get some clarity right quick for you. Okay. So let's say for instance we marked up a chart at this point in time. So we saw that price was coming down on our 4 hour. So of course we want to get in for a sell at some point during this trend, right? So I've marked my macro, my swing highs and my swing lows. And right now, let's say for instance, price is right here. So I see that prices went into my zone, which is what we look for on if we mark a fair value gap on the 4 hour. You don't have to mark a fair value gap on the 4 hour, but if you want to, that is a major confluence. So I marked my fair value gap, price entered my fair value gap, and now it's dropped out of it. So at some point here, price should have did a change of character on my lower time frame. I probably missed it because price is right here. But if I drop down to the 15-minute, okay, we'll see right here, price came into the zone. And then here's my change of character right here. Now, most of the time, I'll put an alert at my zone. Like I probably would have put an alert right here on the 4 hour. And then I can't set it because it's replay, but you would set this alert as like 4 hour zone entry or something like that. So when price would have made this move up, I would have known, okay, let me get to the chart and then look for a change of character on my lower time frame. So there was a change of character here. So that's the first step we look for when we're looking for our entry. Is there a break of structure or a change of character, which is still a form of break of structure? Okay. And then I always teach that if we have a break of structure or change of character, it leaves behind two things, a fair value gap and an order block. If you are in a 4 hour zone and it does this, that is double confluence. That is a very good trade setup. So we have a fair value gap and an order block within that 4 hour zone. That is gold for price action. Change this color here. This is fair value gap. I'll delete this real quick. Okay, so where would you take your entry at this area? There's two ways you can take your entry. You can do an aggressive entry or you can do a conservative entry. So aggressive would have been after this candlestick closed, it created your fair value gap. So after I see that fair value gap immediately, I would place my entry line right at the fair value gap and I would place my stop loss above the order block because every time I find a fair value gap, there should be an order block, which is the candlestick before that candle. So that's always where I place my order block. And I would place my stop loss above the high of that order block and then make it a 1 to 3 minimum. Okay, let's thin this out. Okay, and then this would have went into profit. See if it hit TP here. And then it hit TP. So that is how I entered. That's an aggressive entry. What would have been a conservative entry is you wait for it to confirm that it wants to keep going down. So it came into the 4 hour fair value gap. It created change of character. Okay, it made its first move down, but then it needs to do another move down. So it came back up. I'm on the 15-minute when I'm doing this. Yes, I'm on the 15 or 5 when I'm entering, always. I don't enter anything higher. So it left another order block here. Actually, let's do this one. Oh no, I did that one already. What am I talking about? So it came in immediately right here. This would have been the second entry right here. So you could have either waited here, you could have got in immediately here with this up candle where I immediately drew out my zones, and right after this doji candle here, that would have been my aggressive entry. Or you could have waited until it came back up, back into this zone. Usually it'll do something like this though. So let's say this was our change of character, came in, and then it would have did another break. So this is our change of character break here. And then your zones somewhere up here. Okay, so it came into this zone and it dropped again, which would need to create another low. So you would wait for another low to be created. Let me see if I can find that over here so it can make more sense. See, we have this. This came up. Okay, that would have been too ugly. So your entry would have been somewhere. Not, you would have missed the second entry if you didn't do aggressive. So yeah, that happens sometimes too. So yeah, you would either get in right here or right here. Sometimes I miss trades, it happens. Sometimes price just takes off, that's gonna happen. But you would be looking for a second low to be created, the retracement after that second low. And then I guess you can consider this the second low because the low technically started right here after this doji. But that would be a conservative entry. Is after change of character, you need a second low or high if you're doing a bullish trend, and then get in back in the retracement after the second low. Is that making sense, or does that sound like word vomit? Or I want to make sure that makes sense to you. But that is my entry setup all the time. Is if you ever look at my charts that I post in with profits or take profits, I always have an OB or a fair value gap on my chart, and I'm looking for entry into the fair value gap. Sometimes it goes up to the order block too, and that is why I put my stop loss over the order block, because it can. Now, if say for instance I did an aggressive entry right here, and my order block and fair value gap was so big that it was like a 20 pip or 30 pip stop loss, that is when I go down to my 5 minute and I look for this same structure, and I find my fair value gap and order block on the 5 minute, and that should cut your stop loss in half or even further. So that's when I go down to the 5 minute. Is with the 15 minute stop loss is way too big, or my areas were way too big on that time frame. But this is the structure you want. Change of character, break a structure, and then look for your fair value gap order block, wait for price to come back into that, and then you can enter right off the fair value gap if you want, or you can wait for a second low or high to form and get in on the retracement from that second low or high. Okay. Okay, good. And that'll take some practice. So definitely practice that. Practice if you prefer this, because we know we teach supply and demand too. Me and Jigga is order blocks and fair value gaps, and Mario and I am is supply and demand. So we do both of those because some people see supply and demand way easier than they see fair value gaps and order blocks. Me, I was trying to see that, so I always see them everywhere. So if you see fair value gaps and order blocks easier, use them. Don't force yourself to do supply and demand if it doesn't make sense to you. Because I've tried supply and demand, and for some reason I can't get it. So I stick to what I know and what feels natural to me. Okay, so everybody got that portion? Everybody good on that? Okay, good. Thumbs up. Okay, great. All right. So in the document that I uploaded, there's a font in red that says opening a broker's account, demo on live accounts, funding your account, determining your lot size. Those are 2 whole videos and 2 whole webinars I went over, so I'm not going to go into those. If you need to know how to open a broker, you need to know how to set up a demo on live account and how to fund your live account, you can search for the Everything Forex Zoom huddle in the previous Zoom channel. And if you need to learn how to use the calculator to determine your lot size for your trades, that is in week 3, class 1, risk management. I put that in the document if you need to learn what to search for in all the previous videos. So those go over those step by step. Okay, so what is something that you may need to do before you decide to enter a trade before your session starts? One of the most important things you need to do, and sometimes I even forget to do it, is check economic news releases. So, of course, the more important ones is what we call red folder news in the trading community. So if you ever go to forexfactory.com, okay, and you want to look for, sometimes you can do the whole weekly. I do look at the whole weekly outlook, or you can do it day by day. But you need to know what is red, like these little red folders showing up here. Those are what's going to make price act crazy on your charts. All right. So you need to know what time and for what currency are these red folders going to or show up for. And these are what's called economic news announcements. The most important ones you'll hear of for the US dollar are CPI, non-farmers payroll, unemployment rates, and FOMC, or the Fed interest rate meeting. And then I think there's GDP too. And I did put a chart in the document at the bottom. It will show you everything that we considered a red folder. The first block of that chart is what you probably need to mainly focus on. But some people trade news. I do not. I like regular price action. I like movement to flow how it naturally should. And the candlesticks for news, red folder news, are so erratic, and it makes sometimes price constrict after they've been released as well, or released before, or it constricts before they're released, that I don't like to touch news or news days sometimes because it's just not predictable, quote unquote. So that is why it's important to check that. Now, I also will check it for orange and yellow because sometimes the market can be moving a little slow, and sometimes you need volume to push your, like if you're waiting for a TP to be hit, you need that volume for price to go up or down to your TP. So not red, orange and yellow will give price action some volume sometimes. So sometimes I like to see that in the news releases as well. News affects all sessions. Yes, it depends on what time it's going to be announced, though. There is a lot of news that gets announced during New York. We do get news for London. A lot of the times it's going to be for the GBP pair, though, so you can't get CPI news for the British pound. But that's when a lot of news releases will get pushed out. So that's why I avoided NY for a long time, because I was like, I don't want to be trading all that news. But if you check and you stay ahead of it, then you know what to expect. You know when to get in and when to get out. So always, Forex Factory is a very, very popular site people will use to check their news announcements. There's also investing.com, and you can also use myfxbook.com. But most of the time people are referring to Forex Factory because it has the infamous red folders on them. So definitely check that. See what time is going to be released. So let me see if I can find a red folder on here for USD. So here's one for August 23rd, 8:45 a.m. This is Central Time because it's set to my time frame. So this is 15 minutes after New York open. So this is actually 9:30 a.m. 9:45 a.m. Eastern Standard Time. So after market opens in New York, it's going to be news 15 minutes after that. That is going to be red folder. So you just want to be very cautious of that. Again, if you are experienced or advanced, you can trade news. If you're not advanced or experienced, or you don't know what to expect, I would stay away from it. I would wait until 10:15 to enter any trade after this gets released. And also look at price on the chart and make sure whatever you're trading, price is looking normal and it's not moving erratically as well still. Any questions on economic news releases? Everybody understand why it's important, why you should check it before you enter your trades during your sessions? Okay, good, good. All right, so trade sessions. What are trade sessions? There are four main trade sessions. Let's see, there is a link I gave you guys in the document that links to this website here, which is called forexmarkethours.com. It will let you know, you can set it to your time zone, and it will let you know what market you are in. Of course, the most popular are London and New York. They overlap. after a certain period of time. And then there's Sydney. Nobody really cares about Sydney. Nobody ever talks about the Australian market at all. It's always Asian. Um, yeah, nobody cares about Sydney, mainly because it's after 2 hours of its opening, Asian kind of comes in and take over. And the first 2 hours of Sydney is the time where your spreads will increase exponentially. Like this is the time where the New York market closes, which is 5 p.m. Eastern. After that 5 p.m. Eastern, traders are closing their positions, people are leaving the market. Your spread will 100%, no matter what broker you have, will increase so large. It is not worth holding that trade. You will also get what's called rollover fees once the market reopens. So based on what pair you were trading, that could be a negative deduction or a positive. I don't bank on it at all. I just make sure I'm out the trade before 5 p.m. Eastern. If you plan on trading prop firms, this is something to consider as well because you don't want to hit your drawdown or whatever. So this is why nobody cares about Sydney's, because the first 2 hours is that hour, or this first hour, excuse me, is the hour where spreads increase. People are losing money, losing profits. You get stuck. You can't exit a trade or enter a trade because the market is technically closed. So that is mainly we care about London, New York, and Asian. So those are the main markets. Everybody should know London opens up at 9. Well, technically, I mean, not London. New York technically opens up at 8. I always say that, but because people are so used to the 9:30 bell, they always say it's 9:30 a.m. Eastern, but no, it's actually 8, or yeah, 8. And then London officially opens up at 3 a.m. And then Asian, of course, is 7 p.m. Eastern Standard Time. If you're switching, then you will be heavily affected by the spread. I mean, if you're swinging. So for swingers, I hate saying swingers, for swing traders, swing traders, they put in smaller lot size because you're entering a position with a huger stop loss, because you're accounting for huge moves and you're holding for a long period of time. So it's not unlikely for a swing trader to enter a position size with a 0.10 lot, which is what, $1 per pip. So they'll enter for very, very small lots. So the market closing and the spread widening doesn't affect their bottom dollar. It doesn't affect their profits because they're holding for longer periods of time. And position traders too. There are some forex traders who hold for months. I forgot the name of this YouTuber. He was known for entering markets and would hold for a month or more at a time, and he will make thousands and thousands of dollars. But he was entering the market on very small lot sizes, and then he would scale in with additional positions over time. So those periods of time in the market where the spread would increase during market close doesn't affect him because he's been holding for so long that it doesn't really eat into his profits at all. So yeah, so if you plan on swing trading, you typically don't have to worry about the market close and the spread getting larger, because it's going to come back down anyway when market opens back up and the market becomes liquid again. But you also want to make sure that you're not entering a swing trade on a one standard lot either, if your account can't handle it, because you also have to account for the market close if you're over leveraging or putting too large of a lot size on a swing trade. Your swing trades shouldn't have huge lot sizes on them unless you have 500K account or something like that. So just a little spiel on that. But those are the 4 market sessions. Again, nobody cares about Sydney, so it's just the official ones we care about is London, New York, and Asian. Any questions on market sessions and what time they start? And if you do have a favorite currency pair to trade, like if you like GBP USD, of course, the best time to trade that pair would be London because of the British pound. And if you like to trade anything that begins with USD, of course, New York, anything that's paired with USD, you can pretty much trade in New York because, not to sound like a cocky American, but the New York market is the main one. And, we the US dollars here. So everybody goes off of the New York time. So yeah. So if I were to put them on a totem pole, New York market would be first trade, London would be second, Asian would be last. Okay, any other questions? We all good on that? Okay. All right, I'm gonna move on down. All right. The next thing was, how do I enter a trade, or when do I enter a trade? We kind of went over that already though. So we went over break of structure, fair value gap, the order block. I didn't go into details, but y'all know I trade off fair value gaps and order blocks. Of course, you want to wait for the retracement into those areas. Okay. And if you want an aggressive entry, you would enter right off, like right as price is entering your zone. If you're doing a safe entry, you want it to enter your zone, come down and create another low, or if it's coming down into your zone, come back up and create another high, and then you wait for the next retracement and enter off of that retracement. That's a safe entry. Okay, what are some confluences? So confluences are things that help you feel extra confident in your trade decision. So confluences can be higher time frame trends, which is what we do naturally when we teach y'all how to mark up your 4 hour. Indicators. As y'all know, I coded an indicator. That is a huge confluence. If you decide to use that. So there's also ones people use Bollinger Bands, RSI, stuff like that. Those are indicators. Those are things that they use as confluence. Trader sentiment. I don't like trader sentiment because it is very finicky. Trader sentiment is where you would go to a website or some type of tool and it would tell you what most traders are entering for. So if they think that the US dollar versus the Euro USD is going to be bullish, then some people go off of that sentiment and try to, attune their bias to that. But again, like I said, it's very finicky. It could change at a hat's moment. Some traders may think, okay, well, I was wrong, so now I'm bearish. Another way to look at trader sentiment as well, though, is like if you're in a trading group, like if you're in our Discord and everybody is trading gold or trading NAS 100, and we've seen NAS drop all week. So that was trader sentiment. Everybody was entering sales for NAS. So that's another way you can utilize trader sentiment. Fundamental news. Fundamental news is like the sibling that nobody really pays attention to in Forex because we go off of economic news releases. Fundamental news is more important in options, stock trading. Yeah, yeah, the middle child. So fundamental news, of course, is your Bloomberg's, your Yahoo News, like what is going on in that country. Like I think let's say if for instance, if Hawaii was a country, we saw that there's been some huge fires in Hawaii. I know Hawaii is a state, but let's pretend it's a country. Um, if it was a country and that those huge fires, that's going to affect its economic status. So of course that would bring, if they had its own currency, it would bring that currency down. Let's say like I think where's some places in Asia that has like huge like tsunamis or something. Well, I think Japan gets earthquakes or something like that. Like I'm not too big on geography and stuff like that, but I know there's one of them countries get tsunamis and earthquakes. Like if something like that happens in those Asian countries, then you would think, okay, let me look at how that's affecting their currency. But I don't trade fundamental news. Personally, I'm not well versed in it. Again, this is something I saw that was way more important in stocks. So if you trade stock options or you're a stock holder, fundamental news will affect you much more heavier than it will in Forex trading. But some people still do it. Chart breakout patterns. I touched on patterns earlier, like the M's, the W's. There's also wedges and flags. Some people see those on the chart, and if there's a breakout of that pattern, that is confluence for them that their bias was right. Like if it breaks out to the downside, of course, they're in for sales. And then candlestick patterns. We do kind of use candlestick patterns, but we don't really preach it, but they naturally come into play because when you have change of character, you need what's called an engulfing candle. And I'll go back to the chart for that. So right here, where we had a change of character, this long candlestick is a candlestick pattern. That is called a bearish engulfing candle. You need these every time you have a break of structure or a change of character. That is natural. It goes hand in hand. So we kind of do utilize candlestick patterns, but there's like a whole bunch of them. And I know like there's a book called the Candlestick Bible. You can read that. I've never read it. I never needed to read it because I already know there's like so many patterns you could utilize and there's so many names. And I only trade the ones I see the most and I see all the time. And I only see like dojis and bearish engulfing and bullish engulfing candles all the time. So those are the only candlestick patterns I will point out. Any questions on what I just went over? Different types of confluences. Any questions about confluences? Does everybody understand what a confluence is? Yay, nay. All good. Good. Okay. Good. Y'all, there's a few people in here. I only see Kay here speaking now. Y'all can speak back to me now. Let me know something. I need to know if y'all good. I don't need y'all leaving here still confused. Okay, good. All right. So, okay, making sure, making sure. All right, so the last part of this webinar, well, I will say this last part I'm gonna preach on or teach on, and then after that, I'm gonna open the floor up to whatever y'all need help on. Sway has spoken, yes. So the last part, of course, was determining your trading style. So this is if you're going to be a scalper, intraday, or a swing or position. So a scalper is most likely going to trade on the 1 minute or the 5 minute. You're typically going to get in and out your trade within an hour. You're not going to stay in a trade for more than an hour. So let's say you probably would have entered here for a sell or something like that. This would have been a scalp. So we entered here or something like that, just for example, and then got your 1 to 3. This is actually 1 to 5, which was really good. But this trade only lasted, I'm sure this actually was 10 to 12. Okay, that was 2 hours. Well, still, it's still scalp. It's on the 5 minute, but it's typically an hour that you'll be out. If he was a 1 to 3, I'm pretty sure that would have been within the hour. Yeah, so 1 to 3 would have been, yeah, like 9:55 to 10:10. What is that? That's like 15 minutes or something. So yeah, so if you're scalping, you're in and out. You're not holding a trade for very long. If you were intraday, that is me. I'm an intraday trader. I enter off the 15 or 5. If I'm enter on the 5 though, I'm holding for a lot longer. That is where you're entering a trade and you're holding for hours within the day, but you will be out of your trade before market close. So I'm out before 5 p.m. Eastern. I do not want to be in any trades by market close. So that is intraday trading. I typically will enter around London or early New York, like 7, 8 a.m. Eastern, before the 9:30 bell. So those are usually when I would enter trades. And then I'm typically holding a few hours from those points in time, and I'm usually satisfied before 3 or 4 o'clock Eastern. Swing trader is you're holding for a few days out the week, but you're out of your trade before Friday close. So sometime between, usually typically they'll enter sometime between Monday or Tuesday, and they'll be out by Thursday, the latest, maybe Friday morning. And then last, we have a position trader, which is you're just, it don't matter when you enter the market, you gonna get in when you see opportunity, and you were holding for a month or more. You were in that for the long haul, and you're most likely stacking more trades over time. So those are the those are the multiple types of trading styles. Again, it is you don't have to be just one type. You can be 2 different types at the same time. You can be a scalper and an intraday. You can change from a scalper to an intraday. You can change from a scalper to a swing. It's all based on how you see the market, what is more comfortable for you. It could attune to your lifestyle. When I was still working full time, I was a scalper in the beginning. Sometimes people think that swing trading is a lot better for them because they can enter a trade and then work all week and not have to worry about looking at that trade every single day. They can just hold. It all depends on you and your profile as a trader and what's comfortable for you. Any questions on determining your trading style or the different types of trading styles? Everybody good? So if y'all walk away from this webinar, y'all gonna understand what Forex is, what you're doing when you enter the Forex market, what a currency pair is, what a pip is, how to figure out how much a pip is, marking up your charts. Is there any questions on any of that before I let you guys go out this webinar? Because I want you guys to be good. I want y'all to be able to get into the Discord and flow right on in and not feel lost or left behind, because this webinar is to make sure that everybody's on the same page. I don't want anybody lost. Even if you think your question does not make sense, I don't care if it sounds like Spanish. I will decode it, okay? I will figure it out. Yes, ma'am. What's your question?
So, you were saying that for you as an entry day trader, sometimes you um do your markups on London,
Mm-hmm.
then you just kind of wait it out. But you
Mm-hmm.
also said sometimes, well, I don't know how often you may do it, but you may also do your markup at 7:30 before the 9:30 bell. So, my question is what um
Go ahead.
my
Just
question is
go ahead. You're good. You're good.
oh my God. So it's like you feel comfortable. I guess what I'm trying to say is if news is happening, you
Mm-hmm.
wouldn't have even marked it up from London.
So my markup is done before the opening of my session. So I'm not marking up anything when the session opens. So for me, I look at charts every single day. And I'm doing it at a time where the market is quiet and my session has not started. So if I'm planning on, say, y'all know I trade live Tuesdays and Thursdays mornings with y'all for London. I have already looked at my charts before London opened. So I'm not charting anything. I'm now going off of my analysis. So when it opens up, I am now looking for my entry based off of what I've already got my analysis from. Um, with news, sometimes I forget to check news, but news should be checked at the same time you're charting. Like when you sit down to chart, um, before your session, you should have already checked news. You should know what's to come before London opens. You should know what's to come before New York opens. So that's but again, that is based on my routine and my lifestyle. Some people chart everything on Sunday before the market opens for the week. So some people will mark everything up on Sunday and then have their analysis based on whatever pairs they marked up, and then they're ready to sit down for their New York or London session. For me, the market is always changing and fluctuating, so I choose to mark up my charts. Typically, it's probably going to be an Asian session because that's a quieter session, and then I'm ready to go during New York and London. Did that answer your question, or did that make sense?
Yeah, it kind of it answered it. I guess what I'm still a little confused on is like if that folder is red
Mm-hmm.
and it says it has a time by a time by it, right?
Mm-hmm.
Um, so let's say you were
Are you
like, what
asking
if
like how do I incorporate red folder news while I'm trading?
right? That's exactly what I'm asking.
So for me, red folder news is also it's going to tell you what currency it's affecting. So let's say for instance, I see red folder, it's going to tell me what the red folder news is, what's the announcement going to be, and it's going to say, for instance, going to be for GBP pairs. Most of the time, I'm not going to touch the GPP pairs unless I'm like very confident in my trade. There is a more advanced way of trading news, and it's called liquidity based trading. And that's when you know that news is going to push price to your area of liquidity and then take off from that area. That is more advanced. So I can do that, but most times I choose not to. So if it tells me that that red folder is for GPP, I will go look at something else like the Aussie USD or something like that. I'll go look at a different pair that the red folder news does not affect. Does that make sense?
Yes, that makes sense. Thank you.
No problem. Can you show how you mark your chart again or what you mainly look for and talk about my journey with absolutely. So for charting, let's pull up a chart here. I'm gonna have to go back in time because the market closed and left price ranging. Okay, this is a perfect one here. So let's say I was looking at this pair, which is the GBP AUD. So initially, the first thing notice on the screen is it trending or is it ranging? So this is clearly a trending market. Okay, so on the 4-hour, I'm going to mark my highs and my lows. So sometimes I'll do this as well, just to make it easier. You don't have to start all the way from the bottom because you need to know where prices currently is. That's the most important. So all you need is really this part. But if you need all of this, you can do this. It's your preference. Okay, so I have my swing high, swing low, swing high. So now I'm going to mark, for me, I'm going to mark my lows because I'm in an uptrend and price shouldn't break these lows if it's going to continue up. So now I see that, okay, we have a higher low here, a higher low here. Okay, it broke this high, pushed up, but we have no retracement yet. So of course, in order to get in for the buy to continue up, I need some type of retracement down to get in for. So I'm going to be looking for a change of character on my lower time frame for the retracement. So now I'll probably make a note to myself somewhere on my chart, waiting for change of character. You don't have to do this. It's just what I do. I utilize notes for myself. Okay. And then I would move down to the 15-minute and see, am I getting my change of character to confirm the retracement on the 4-hour? So now you can trade the retracement because again, a 4-hour move is a very long, huge move on the lower time frame, but I would only advise this for experienced traders to trade counter trend. So go down to my 15-minute. So again, what do we look for when we're marking up charts? What trend do we see a trend? Where is price at? If we're looking for entry, where's my entry going to be? So we are here. Okay, and then there has been a change of character already. Okay, it was right here. So I missed this. This would have been a good sell. Okay, this is chalk. Okay, and then what do we see when there's a break of structure? Or what does a break of structure or a change of character leave behind? Does anybody remember what I said about that? If there's a break of structure or a change of character, what does it leave behind? Anybody know? Yep, perfect. Fair value gap and order block. So here is my fair value gap. Yep, imbalance is right as well. Imbalance is the same thing as a fair value gap. And then there's always an order block on top or below my fair value gap. Okay, so I'm an aggressive entry trader. So my entry would have been right here, right off of the zone. Okay, then brought my stop loss above the order block. Now, this is a 34.5 pip stop loss. What did I say I do if the stop loss is too huge on my 15-minute? Anybody remember? Anybody know? What do I do if the stop loss is too huge on my 15-minute? Yep, go down to the 5-minute. So I'm going to take this off. Actually, I'm going to try to rewind it so it'll make more sense. Okay, so once I measured that out, immediately I would have said, okay, this is huge. Now I'm just going to wait for price to come into my zone. And then I need what to happen in this zone on the 5-minute to enter. What do I need to happen again? Yep, change of character. So I'm going to go down to my 5-minute. Okay, now I'm waiting for another change of character. Let's see what happens. Right there, boom. Change of character. So right here. Okay, in the zone. What did it leave behind when it gave me a change of character? Yep, fair value gap. What did it also leave me? What is behind or in front of a fair value gap? Yep, order block. So I'm going to change this to, this is a fair value gap. And then here is my candlestick for the order block. Okay, now let's measure out our new stop loss. Now we have a 14.3 stop loss. That is very good. Below 20 or below is what I'm aiming for a stop loss. Now Jigga will go down to the 1 minute. The way my anxiety is set up, I can't do it. Okay, I'm not a 1 minute trader. 5 minute is as low as I will typically go. Okay, what is my minimum risk to reward for a trade? Good, 1 to 3. You wish you was doing this on the chart. This was easy. Got me feeling like a pro. Hey, look, you're doing good. Okay, that's what I like to see. I need to know that y'all are understanding the process. That is really good. Okay, so now let's see what we get. Hopefully, don't take my butt out. And it was a win, but we're gonna see. Good. Okay, perfect. Now y'all see why I'm an aggressive trader. It kissed the fair value gap and dropped. And this ultimately, if you trailed your profits, you would have got a 1, 2, 6. So if you risked $100, you would have made $600. Aggressive kiss. Yes, it was. So, and this trade was from 4:10 to 6:10. So 2 hours, about 2 hours and some change. And that is, of course, intradays, you will be holding for an hour or more. And that is how I chart and enter trades. Of course, this whole thing is a counter trend because why? On the 4 hour, this is a bearish move and we are overall bullish. So y'all see price is starting to drop. We should be getting a retracement here. So you could hold, like, now this is where Fibonacci comes into play. Why I use Fibonacci is used to anticipate a retracement move. Okay, so let's say we were anticipating price. You want price to come down to at least the 50%. So I would do something like this. I would mark this zone here on the 50% of this swing high because we expect it to retrace to continue up. So you could have held to at least this zone and you would have got a 1 to 11. So you would have entered off of a 5-minute chart and held for a 4-hour move and gotten $1,100 if you risk $100. Let's see. Is okay. I forgot the market's closed, so it's ranging right now because the market is finicky when it closes. But if it was still open, like say this was a Wednesday or Thursday, we probably would have got an easier move to the downside. But that is how I would do it. One more, you just got here. Y'all are putting in this work. I'm making me put this work today, huh? It's fine. Okay, cool. So did everybody understand what I just did there? Everybody good? They understood how I got to that point, why I entered my trades and the okay, cool.
I got a quick question.
Sure, go ahead.
You said the overall market was, oh man, okay. On the other example you just did, the market overall on the 4-hour, it was bullish.
Yes, it was. Let me go back to it.
Okay.
Okay, so see how we are making higher lows and higher highs? As long as price doesn't, the reason why I only mark my lows in an uptrend and vice versa in a downtrend, I will also only mark my highs in a downtrend is because your trend is not invalidated until price comes and breaks one of these lows. That's when, because of course that is what is that called when it breaks this low?
Change of character, right?
Yep, exactly. So a change of character is an indication that there's going to be a trend change. So the reason why I only mark my lows in the uptrend is because I don't really care about the highs. I need to make sure that it's not breaking the previous low because that means it's going to keep going up. Till it breaks one of these lows, then the trend is still bullish for me. Okay, did I answer your question, Kay?
Yeah. when you did do the markups,
Mm-hmm.
so basically since it changed character,
Mm-hmm.
then it was going bearish, right?
Yes, on the smaller time frame. So what
Oh,
it's doing
okay.
right now is called counter trending. So our
Mhm.
main trend on the higher time frame is bullish. So the small move on the 15-minute is called a counter trend trade because this is essentially a retracement on the 4-hour is what it's doing. It's trying to make its way down to the 50% level of the swing high. Price tip when we do retracements and when I do a webinar on Fibonacci, y'all understand retracements, they aim for the 50% zone of your swing. So sometimes it will come down lower than that. So let me measure this out again. So this is our swing high on the 4-hour, these blue lines here. This middle line is the 50% portion of that swing. So in order to get in back for a buy and take the back up for the 4-hour move, you want to get in for a buy somewhere down here. This is called a discounted zone. You want to buy in a discount, which means buy low, or sell in a premium, which means sell high. So when we are getting in on retracements, your retracements should always come at least to the 50% level. If it does not come to the 50% level, it's probably not done and it might be trying to fake you out. But when price gets down here, then I'll be looking for buys again. But until it gets down here, all this that's moving, it should come down here at some point. This is a retracement move. This is ranging right now, but all of this, oops, delete that. Okay, this ranging, but hopefully it does something like this and come down here. Now we're in the discount zone and we should be looking to take buy. So we look for a change of character somewhere in this area. So this is retracement. And if I go back to my 4-hour, we see that this move is coming out of that area and we're going back up for buys. But if this whole retracement moves comes down here, then now it's invalidated and we should be looking to get in for sales from here on out because we're getting a change of character. Did that make sense or did I answer your question?
Yeah, that makes sense. Thank you.
Mm-hmm. All right, so let me try to do it one more time. Any other questions before I do another chart markup? Anybody have any questions on what y'all saw on this chart? Okay. I don't know why I just want to hold down and okay, there we go. All right, let's see. I'm a big advocate for if it looks ugly, leave it alone. If your chart does not make sense, if it looks like chicken scratch, don't mark it up. Go find something that is easier to mark up. I'm not gonna give myself a headache. It is not worth it. Okay, let's do this one. Actually, let me go here. All right, so at this point in time, this was an uptrend. Okay, so in an uptrend, what do I only care about marking up? Does anybody remember what I said about that?
Lows, right?
Yep, I only care about the lows. Why do I only care about the lows in an uptrend?
Because if it's broken, it could go to a bearish bullshit,
What would
right?
cause it? What would cause it to go into a bearish trend?
A change of character.
Absolutely. And what does it need to break in order for it to be a change of character in an uptrend?
One of the recent lows.
Yep, exactly. Good. All right. So y'all are doing amazing. So here are my lows. Actually, I'm gonna go up here because this is way too far down on the 4-hour. I care about the recent lows. Okay, so we're moving up. We have our recent lows marked. What is it doing right here? What is this called?
The retracement.
A retracement. Good. What pairs do you recommend for beginners to add on the watch list? all the majors. Anything attached to a USD pair is always recommended for beginners. So Euro USD, GBP USD, Aussie USD, or AUD USD. I don't like USD JPY. I just don't, but you can add it. I have a love-hate relationship with that pair. But those are really good for beginners. Okay, so I'm waiting for, at this point, I would have waited for chalk, but I would have missed the move. So if I was marking up at this point, I would have been like, dang, this would have been a good entry to get in for, but I missed it. So let me just go down and see what's happening on my 15-minute to see if I can get in or do I need to wait. So you can also do the thing I showed you where you can measure out the 50% level and see if price has already dipped into it. Because what happens in this area of this retracement? What happens in this discounted area? What are we looking for when price gets here?
We're
Anybody know?
looking for it to go down, so
Right, rally. We need it when if it comes down here below the 50% level in a retracement, we need to buy up. From some point down here, we're buying up. Okay. If it doesn't come down below the 50% level, it's probably trying to fake you out and it's still going to keep pushing up. Okay, so let's go down to the 15. All right, let's see. Do we see where the change of character was? Where's a good one? So it really, all it did was really range from here. All this is ranging. Okay, it's not really pretty. And then advanced knowledge, all this is called considered liquidity. So when it came up, it really just took this out. So it did come into a fair value gap and an order block area though. So there's the fair value gap. It destroyed the fair value gap, but an order block was still up here. Okay. There's not really, this is what I would have considered the last low. It didn't really take out, unless you consider this wick here low, which for me, I wouldn't have caught that. But what I would have charted is my fair value gap in my order block here. Because that is an area that price is attracted to. Fair value gaps and order blocks are like magnets in the market for price. So I still would have marked those. Okay. So I would have missed this whole move. Okay. So I'm like, okay, well, the retracement is moving on the 4-hour. I missed an opportunity to get in on this sell. It's breaking structure. This is the most recent break of structure to the downside. Okay. That's a sucky one because there's no fair value. Well, actually, no, I'm lying. Right here. This is the one I would count because it left behind a fair value gap and an order block. So that's the most recent break of structure for me. Okay, so basically I'm sitting on my hands right now because there's no point of entry for me. This would have been my second point of entry, but it's already tapped into it and took off. So now I would just be watching. Now we're in the discount zone of the 4-hour. If I go back up to my 4-hour, it's past the 50%. So I've missed out on this whole retracement move. So now all I need to do is wait for a change of character back up to the upside for the continuation move. So let me go back down to my 15. And let's see if we get a change of character to the upside. Still pushing down. Okay. Let's see. This would be the last high for me. Okay, it's not the cleanest because for me, I like very, very energetic pushes. This is like a doji, and that means indecision when you see a doji, and I don't like that. But it's still tradable if you want. You can still mark the fair value gap if you like. Just know that if it was a doji here at the break, that is a little bit riskier because again, that is indecision in the market. Okay. All right. And I probably would have waited first, but if you wanted to, let's see if you could have traded this. Let's see if it would have been a good trade. Let's see, below 22.5. We'll take it. Okay. And then when you are doing a continuation trade on the 4-hour, you want to go to the most recent high. So this is our 4-hour high right here. So that's where you want to take it first, or that's where you want to make your TP. If you're gonna, it's not your necessarily your first TP, but that's your ultimate TP. So let's see what happens. Okay, it's moving. It's still a little finicky, but we got to a, oh no, that was definitely a 1 to 3. Yeah, it was somewhere down here. So if you were doing a 1 to 3, you would have took profit somewhere over here. But it wasn't done. It gave us a change of character on the 4-hour, which I saw that earlier when we went to this chart. But you still would have got in on the retrace after the retracement for a push up, and then got your 1 to 3. But now the market is changing its mind and it wants to go bearish. It's done with its bullish run, and it gave us a change of character on the 4-hour here with this huge bearish engulfing candle. So if I would have saw that on the 15-minute, I would have been like, "Whoo, thank God I got out that trade early." And now you have your change of character. Now you're looking for sells and looking for the 4-hour to continue bearish. Did that make sense, guys and gals? Any questions on that process? All right. Any other questions before tonight's webinar end? Now or never, or forever hold your peace, or whatever they say. I'm here to help y'all. So like I say, anything that y'all have on your mind, do not be afraid to ask. Even if you feel like your question does not make sense, please ask it, because somebody else may be thinking the same thing. Everybody's good, 100%.
Okay, one question.
Mm-hmm.
Break of structure and change of character, basically the same thing, right?
They are, change of character is still a break of structure. The only difference between the two is that change of character will break a lower high or a higher low. Break of structure, when we say break of structure, is typically breaking a higher high or a higher low. So
Okay.
change of character is still a break of structure. It's just a typical break of structure that changes the trend. Does that make sense?
Yeah, I got it. Thank you.
Cool. All right. Everybody else good? If not, if y'all don't have any more questions, I'm finna go eat some dinner. So I'm finna go. So y'all are fine. Again, feel free to ask me any questions in the Discord. If you do, you're welcome. It is my pleasure. I love helping. If you find sometimes questions do come after the webinar is over, I completely understand that. So if they do come to you, please feel free to ask me. I'm here. Ask it. Strike while the iron's hot, y'all, because when them questions pop up in your head, do not wait to ask. Ask right away. At me right away. If I don't answer right away, I will answer you at some point. Sometimes I even go up and read previous chats to make sure nothing was missed. Thank you, you too, Essence. But please ask right away. And I guess if I don't know the answer, I will research it for you and get that to you. But this was to help you guys, everybody get caught up to speed and get on one same accord, because we want everybody to be ready before September 1st. So yes, please again, mark charts as much as you can, get some muscle memory, get used to watching price action as much as you can, because that is the most important tool you're going to have when understanding the nuances of the market. Because there is such thing as trader's edge. There is a such thing as intuition. And the more you utilize the tools and get used to using them, the more your intuition will come into play and you will understand market nuance. So if that is all, if there's no more questions, I will upload this recording, excuse me, later. And y'all all have a great evening and enjoy the rest of y'all's weekend.
Have a good night.
Y'all too. Good night.